It's becoming more and more of a prevalent paradigm within software, as an example, like consumption-based pricing. So the Datadogs made it popular, and there is research out there that shows that your consumption-based pricing SaaS company, your multiple is going to be higher than your average SaaS company. So we're currently wrapping up QOE for one company where they have like a ramp in terms of the contract amount, right? So the first 6 months of the contract were this smaller number, that it ramps to this larger number, right? But the thing is that the performance obligation hasn't changed. And because they've gone to the second portion of the contract, they're stating a higher ARR number. But because the performance obligation hasn't changed, instead, like what they should be doing is taking that entire TCV and dividing it by the total number of contracted months. Thanks for having me, Jay. So to give you some background on myself, I spent my entire career at the intersection of finance and technology. Started my career in investment banking, did a couple years in venture capital after that, but then spent most of my career running finance teams at a number of different startups, from early to growth to late stage. And back in 2020, I opened the Brazen Path, which is a finance and accounting firm serving the needs of funds and early and growth stage companies, and went full time into it. Started 23. So today we tackle a few different things. For funds, for investment managers, we do quality of earnings reports for them, which is, I think, what we're going to dive into today. But then for companies, we also help them with financial planning, strategic finance around fundraising and M&A, and then also controller work, right? So as they're preparing for audits, we can support them on that end and then just generally help them with cleanup. I also I'm a partner in a commercial real estate investment company, which, is it's not that dissimilar from buy small businesses.
Nice.
Hey, Jeremy.
Let's dive into that whole due diligence for funds. So these funds, are they buying other startups, or are they buying companies that are teams that are not doing so well? So what kind of acquisitions are they doing?
Yeah, so the one that we've been working the closest with, they are an early growth investment firm, and it's a new category within the growth equity world, right? Where traditionally, with buying software businesses, growth equity firms would come in when they're around 7 to 10 million in ARR. The client that I'm working with quite a bit, and then others that have popped up in the space, they're now investing in software companies that are doing between 1 to 2 million in recurring revenue, right? So what they've noticed is that, especially with vertical software, right, which have smaller markets, they might not necessarily be venture scale businesses, but there is a path to profitability sooner than later. And oftentimes when this fund is jumping in, they're already profitable, right? So it's a model of slower growth but profitability, and the goal is to grow these businesses to 7 to 10 million in recurring revenue, so that the larger growth equity player can then just jump in, or explore sale at that point. So that's probably what they do, taking minority stakes in software business doing 1 to 3 million recurring revenue.
So what does that due diligence look like?
It's a few different things. So for them, unlike many of you, they're really focused on revenue and really nailing the recurring revenue number, because that's what they're paying on a multiple basis. And so it's deep contract review, right? So even if they have 200 plus contracts, we'll go through every single contract and try to come up with our own picture of what recurring revenue on an annualized basis looks like today, right? And oftentimes as we're going through the contracts, we notice discrepancies versus the number that they're presenting. And unfortunately, there isn't a true gap standard on how ARR should be composed. So it ends up being something that's more a fun view. So kind of merging their view with how the company is thinking about it. So that's one big piece of it. We're also digging in to expenses, really understanding how gross margins are being presented. That's a big piece of software companies, right? You want to be north of 80% gross margins optimally, right? So are the or is cost of goods sold being calculated accurately, right? And oftentimes there is debate that comes up, right? So sometimes companies actually are way too conservative on COGS. So they put, full load of customer success expense into that. And then, they might pull in software, right, that should be in OpEx into COGS, which could present an opportunity, right, for restating financials, post investment. But then on the OpEx side, it's very important to understand trends on that end. And then to make sure that expenses are being recognized in an accrual-based manner. And Jay, that's actually the other thing that pops up from time to time, right? That the difference between cash-based financials and accrual-based financials, especially with bootstrap businesses. So sometimes, and this is a major thing in software, especially, right? Because in software, you oftentimes you're being prepaid for 12 months for the contract, right? So on a cash-based basis, you'd be recognizing 12 months, at collection or at signing, whatever the cash-based method is. But, you should be recognizing that over 12 months, right? So you could overstate revenue on that front. And then the last piece is balance sheet. So we're diving in to understand, mainly for software businesses, it's understand the equity stack today, right? And then also understanding any debt obligations that the company has taken on. So it's those three areas plus general like cash tie out, right? So we'll go through bank statements and then compare to what we're seeing in the financials and just make sure that that stuff's footing.
Okay. So let's go back. So I like the breakdown. It's very similar to any other business, honestly. It's not much difference, assuming the details are different, but the same kind of logic. So on the revenue side, can you double click on that? So what do you what are some of the things that you notice on the revenue side that creates that gap between what a company says the IRR is and what you find? And then on the contract, you're going through every client contract one by one. Mm-hmm. So what are the nuances that you find between, and again, what's declared and what's actually is?
Yeah, so I touched on one, which is cash-based versus accrual-based. That tends to be one no-brainer sort of thing to evaluate. But then within the contracts, a couple things that we've come across over the past couple QOEs we've done. There's one company that we were evaluating on behalf of this investor, and it turned out that they had some contracts that were on a credit-based model, right? So you would basically get this software and then you get X number of credits to use. It's recurring revenue if it's time bound, right, by 12 months or 24 months. But if it's not time bound and you have an infinite amount of time to use the credits, it's really not recurring revenue, right? It's transactional revenue. So that was one interesting one that we came across, and that was helpful for the company, right, post investment to like clean those contracts up and then some of that, right? And then
so do you value that revenue? So that's an interesting one because you're buying based on a multiple on ARR. How do you value that revenue that's based on credit that's unlimited?
So it'd be one time, right? Because we wouldn't count it as part of ARR.
Got it. Okay. And how would it's just a one time that ARR, or how did you actually value it?
Yeah. So
a one time EBITDA or.
Yeah, so the thing is, like one-time revenue, like software companies, you're still going off of revenue, and typically it's like 1 to 2x revenue. Is how you value, like, say, implementation revenue, as an example. And if it's like recurring non-software revenue, which some companies are doing, right, like recurring support or recurring services, rule of thumb is like you're valuing it roughly half of what you'd value the software revenue at.
Okay.
Yeah.
But okay. So now, you're saying there's sometimes where you have these discrepancies where with the AR, some revenue that's being counted as ARR, but it's not ARR.
Yeah.
What else are you seeing?
That's one. And then the second one that just top of mind that I'll point to is we're currently wrapping up QOE for one company where they have like a ramp in terms of the contract amount, right? So the first 6 months of the contract were this smaller number, then it ramps to this larger number, right? But the thing is, the performance obligation hasn't changed. And in their number, right, like because they've gone to the second portion of the contract, they're stating a higher ARR number, right? But because the performance obligation hasn't changed, instead, like what they should be doing is taking that entire the TCV and dividing it by the total number of contracted months.
The TCV, total contract value.
Yeah, because again, right, the performance obligation hasn't changed, right?
Yeah.
It's not like seats have been added or something else. So yeah.
Well, okay, got it. So they started low and then they're ramping up later, and then they're making you pay for the higher number as opposed to the average.
Yeah, or basically, like in terms of like what they're representing in ARR, like there's round numbers. Like let's assume like it was like a 12-month contract, right?
Yeah.
First 3 months, it was like 30K roughly, right, in billings, right? But then it went up to 200K over the remaining 9 months. Like it's not 200 over 9 that they're using instead of the 230 over 12.
Are you just assuming that you're going to end up having to re-sign that same contract the following year, and therefore that's not the real value of that contract?
Well, the thing is, like, if they do end up getting that larger number on the renewal, then you can like bake the upsell in then, right? But for this current contract, right, you've got to recognize under the terms of the current contract.
Okay, got it. That's interesting. Yeah, and you're doing this like one contract at a time?
Yeah, we're going one contract at a time. So again, it depends on like what the scope is with the QE. This firm, right, that we're working with, their mandate is for us to go through every single contract.
Wow. And so you have a team doing this?
We have a team, yeah. Yeah, and so my partner, she's ex, she was an auditor at Deloitte. It's her career, and she spent her time across software and consumer goods. She was the assistant controller at Warby Parker at one point in her career. So she's the person I'm really relying on for execution.
Got it. So what else? What are the things that you go deep into on the revenue side before we go into the cost side?
So I think we've touched on a number of the items. If I were to think through, we talked through the credits, talked through that piece. I guess like another thing would be usage, just general like usage based pricing, right? So sometimes like when the billing is done right after a month of usage, sometimes you just want to like check what what is imputed to the platform versus the bill that was actually sent out, right? To basically capture like in arrears the payment for the previous month. Sometimes there are discrepancies that can pop up if a company hasn't tightened the process on that front.
Yeah. So if someone is paying per usage, you want to make sure that whatever invoice was sent out, it actually matches what the actual usage is.
Exactly. Yeah. And the thing is, like, it's becoming more and more of a prevalent paradigm within software. As an example, like consumption-based pricing, right? So the Datadogs, for example, like really, made it popular. And there is, research out there that shows that, if you're a consumption-based pricing SaaS company, your multiple is going to be higher than your average SaaS company. So this is becoming more and more of an issue, right? And unfortunately, Jay, like there isn't like an excellent billing system, a third-party billing system that just automates everything. So there tends to be, for many early stage companies, a manual process on that front.
Why is the consumption base more valuable than the typical, recurring revenue base?
Yeah. So like oftentimes these consumption-based contracts, there is a minimum, right? So it does give you some floor, right? But then there's also upside, right, to be had in the contract, where you're not locked into some sort of ceiling in terms of pricing.
And how do they value those?
So you kind of like marry to a data point, right? So if it's an API company, like for example, like it'd be the number of API calls, like a Twilio, for example. That's how you come up with the overall pricing on that front.
It's like an average for the last 12 months.
So yeah, like basically, or sometimes like what you see is like those companies, they use an ARR number and then they take their last 3 months, right, and kind of take a trailing three to do that, right? But then that causes another issue, which it's like for vertical SaaS, it's something that you're going to look out for more, right? Which is especially like retail focused SaaS, right? The seasonality piece of it, right? So
Yeah.
for example, like
There's always seasonality, no matter what it is.
yeah,
One.
yeah, but like some industries you sell to more than others, right? If you're horizontal, like kind of evens out a bit, right? But if you're vertical, right, and the industry you're selling to is
Yes.
it's seasonal, then yeah, it's going to ultimately affect you. Yeah.
It's interesting. Okay. So how did they figure that out? The whole 3 month thing. You have
Um,
the whole year.
Yeah, so so that's the thing, right? Like there is no set standard on that front, right? So, one of the companies I work with, they're a cloud-based provider, right? And so their pricing is usage-based. And CFO, right? He has gotten this method that is checked off by the auditors, where yeah, he is using trailing 3 months.
Got it. So it's just something that they agree on, and that's it, and they move
Yeah,
on.
yeah.
Okay. Now, how about the cost side? So, what are some of the things that you look at? What's your process on the cost side, and some of the things that come up?
Yeah, so like again, right? Like let's go back to cost of goods sold, right? So let's take a software company again, right? Just to follow along that talk track.
Yeah.
So typically, like what should be there, right? It's your hosting costs, no matter what, right? But then it should also include the costs that are used to power the platform, right? So for example, you wouldn't include things like dev tools in there. So if an engineer is using ChatGPT to get help with code, that's an OpEx, right? As a copilot, but that shouldn't hit cost of goods sold. But sometimes a mistake that companies make is they will only include the hosting there, but not some of the other software. So, for example, the API companies like a Twilio, right, that go into powering the actual platform, right? So that's one thing. Another thing of the cost of goods sold is the labor that falls into there, right?
Yeah.
So customer support for a software company should generally fall into that bucket as well.
Also, good salt.
And to get to cost.
Really?
Yep. If it's customer support, right? Like tactical stuff, right? So helping with logins, helping with this ticket, helping with that ticket. But customer success, there's debate around whether that's included in cost of goods sold, right? And I've seen companies use different methods, and it's one that they have to like run by an auditor that's specific to them. But ideally, there's some time tracking in place to figure out what falls into OpEx versus what falls into COGS, right? Because the customer success role, it's what some of you might know as account management, right? So there might be some tactical support sort of things that they're tackling, right? That should be in cost of goods sold. But then the driving it upsells, driving renewals, having strategic conversations about the platform, that's more OpEx, right? So that covers cost of goods sold, at least for software companies, just as a few data points there. And then on the OpEx side, a few different things, right? So, like one of the main things is it's the difficulty of like accrual versus cash, right? So for example, for software, you're prepaying a lot of software up front for the year, right? So that can cause jumpiness in the expenses depending on what you're purchasing, right? So if you're renewing your Salesforce or your CRM for all your salespeople, it's going to be bumpy, right? So that's one thing. And then, some other things, it's timing of when expenses are hitting, right? So you might prepay for expenses, ahead of an event, right? But the event might happen 3 to 4 months out, right? So for an outsider valuing P&L, that might throw them off a bit, right? In terms of analyzing, why did expenses jump this month versus in future months? And then there's just general like compliance with GAAP and ASC standards. ASC. So for example, and this is something that always changes, or not always changes, but it can change over time, right? So with a standard called ASC 606, the way that commissions were being recognized, that changed, right? So for example, pre-COVID, when that standard wasn't in place, you could recognize commissions, when they were earned with the salesperson. But now you got to like put the commission on the balance sheet and then amortize it over a certain period, right? And oftentimes companies I work with choose 12 months, right? So that's something that not a lot of companies do. When we come in, we have to help them clean that up. And then, take bonuses as an example too, right? You should be accruing for the eligible bonuses that folks should be paying for over the course of the year, right? Even if it's paid out, right, in a on a one-time basis in like, January or February. So it's things like that. It's timing. It's classification, right? Those are typically the sorts of things that we often see with companies.
And do those things affect value, or they just affect, you know, operation or understanding of what the earnings are?
So those two things, they affect more operations. Although I will say that it can affect value if gross margin is unfairly too conservative or it's too aggressive, right? Because oftentimes multiples will correlate to gross margin, right, of a business. John, you got a question?
Yeah, yeah. Go ahead, John.
Yeah, I was curious. Do you look for any expenses you would expect to see? So almost like the absence of an expense, for example, I don't know, workers' comp insurance, or the under calculation of a certain expense. Like, let's say you look at payroll and you see a payroll expense, and it doesn't, equal 7.65% or something of the total, and just like things like that, or is it purely just you're just looking at what they have and whether or not it's in the right period, or whether it should be in COGS or OpEx? Are you actually looking for anything that maybe should be there that isn't?
Yeah, we are looking for stuff that should be there, right? And if it's not there, it does raise questions because, at the end of the day, there is a band to kind of the example that you're calling out, which is things like payroll taxes, benefits, right? That should be a percentage over factor on top of salaries, right? So if you're seeing nothing, right, then it does certainly raise a question. And like if it's zero, right, maybe that means that everyone's a contractor. Okay, so that raises another issue, right? Like, does everyone pass the contractor test then, right? Or if it's overstated, then yeah, you might have some other issue going on. So yeah, we do have things that we're looking out for.
And is there like a rules of thumb that you think of? Like you said earlier, 80% plus gross margin, which is amazing. What is your typical net margin? What are you looking for?
We're not looking for a specific net margin because the thing is, OpEx can really vary company to company, based off of whatever their goals are, right, and structure. And this isn't really a QE or financial diligence thing, right? But there are metrics out there for software companies to like measure. Are they spending too much relative to growth? Are they burning too much? This is kind of off topic a little bit, but one metric that folks really look at software companies is burn multiple, right? So how many dollars are you burning to generate a net new dollar of ARR, right? And for that metric, if you're north of 3, unless you are creating some sort of a next gen AI company or something, it's too high, right? And so oftentimes like early stage startups, you see them between 2 to 3, but investors are now pressuring them to get between 1 to 2. And investors really like it if you're below 1, right? Yeah. So if you're below 1, right, you're coming out ahead, right? In terms of,
yeah, that's interesting. So what else on the COGS or the OpEx? What are you looking for?
Yeah. So what else? For expenses, I think that covers a good bit of it. Sometimes, I mean, again, on reclassification, like you do have COGS versus OpEx, but sometimes you do see reclassification between the OpEx buckets, right? So sometimes between G&A and others, like you're underfeeding G&A, right? So the COO should sit in G&A as an example, but you might see them, in another bucket. So that could be something that pops up. And then I'd say the other thing is, like understanding like CapEx versus OpEx policy at a company. At software companies, it's minor, right? It tends to be like laptops for the most part, right? That hit that threshold. Understanding that is the other piece. And there are some things that should be capitalized versus being expensed. So, for example, like one of the things that founders end up finding out is, if they utilize, I mean, like the law firm that they utilize for a fundraise, the expense associated with that fundraise, that typically gets capitalized on the balance sheet versus expense. So some of those little things.
How about the difference between building the thing and maintaining the thing? So building the software, is that goes to the CapEx or no?
It depends. I mean, oftentimes there is like testing that one does with technical accounting to determine that. But a mistake that I do oftentimes, CJ, is that when companies are pre-revenue, right, they're feeding some of the dev costs into COGS, and that's wrong, right? Because like you're not selling a product, so there shouldn't be any COGS at that point. So the very minimum, it should be OpEx. But yeah, there is testing that's done to determine whether it's like internally built like product, right? That should be a balance sheet asset, or it should hit OpEx.
Interesting. So now balance sheet.
Yeah, so balance sheet. Few different things, right? Not as big a thing for your typical software company, but for example, like an advertising business, like an ad tech business. Working capital is huge, right? So I spent a few years in the ad tech world early on in my career, and the issue with ad tech is that you've got to pay your suppliers of ad inventory a lot sooner than the agencies pay you. Sometimes these agencies can take 3 to 6 months to pay their ad tech provider, and if you're subscale and you don't have like a line of credit or something like that, that can crush you, right? And even now, one of my clients is an ad tech company. They are at scale, right? But that's something that we're constantly watching for them, right? That the working capital is in good shape. And I think for like a lot of the businesses that you guys are looking at, that's a huge thing. Like general contracting, Jay, we've had conversations about that in the past, right?
Yeah.
That is one where I think that's one of the most important metrics to take a look at. So I think you guys get it on that piece. I mean, even in terms of the current assets, current liabilities with current assets, you want to do like inventory testing, right? To make sure that they're using the right sort of inventory methods to account for their inventory that is typical to their industry, right? Because some industries, for example, retail, right, will use FIFO, right? And then others like oil and gas, they'll use LIFO, right, as their inventory method. So that's important. And then you also want to do testing to make sure that the inventory is still valuable, right? That it hasn't gone obsolete, right? It hasn't been sitting on the shelves for 3 years, and no one's gonna like use it.
Have you done any e-commerce?
I have done e-commerce, yeah.
But what do you see there? Because that's an inventory nightmare.
It is, and so there is one company that we're working with where they have like the right line of thinking on their front in terms of like how they are capturing inventory, but we're helping them properly log systems wise inventory, right? And for them, right, that's something that needs to be on the FIFO method, because what they do is they sell things like turmeric shots and ginger shots, things like that, right? So obviously, inventory can go bad pretty quickly.
Yeah.
With a business like that, yeah. So the key thing, it's like it's not only like having your policy, but then the other thing is if you can craft memos around it, defensible memos to present to an auditor down the road, that's another step that companies need to take.
Okay. What else on the balance sheet?
Yep. So those cover some of the current assets, current liabilities. On the other end of things, right? So you do want to understand the equity stack that sits in the company, and understand the current capitalization, right? So in the software world, a lot of folks use safe notes, right, to fund businesses early on. So SAFES, for those of you who are not aware, stands for Simple Agreement for Future Equity. So basically, it's an instrument that's not technically equity, but will convert into equity when a price round does happen at a discount and at a certain cap on the valuation, right? So understanding what that stack looks like is important. If pricing has happened, what does that look like as well, right? And then on the common equity end, it's also important to understand, the cap table and whether there might be debt equity, on the balance sheet. What I mean by debt equity is like sometimes like you start a business with 3 founders, one founder leaves after 2 months, and unfortunately, the founders haven't been on reverse vesting schedules, meaning that they've got to earn that equity along the way, and then someone has 20% of the business or something like that at some point for not really doing anything, right? And that can cause issues down the line, because if the goal is to keep raising financing, it can present like a dilution concerns. Actually, like one of my clients, they're going through that right now where they're raising their Series B, and one founder, he's set to have like 10% of the company, and so he had to negotiate with the lead investor in this round that he gets a decent chunk of the option pool, right, as part of this round to get him to a more respectable ownership level for where the business is. Because the thing is, if the ownership, as is like too low, folks might not be properly incentivized. So
Yeah.
I think that covers on the equity, and then on the debt, you just want to make sure, like, you want to really understand the debt agreements, that the business has, right, and understand, any sort of like restricted covenants that they put on the business, right, around liquidity or any sort of operational covenants. Because for you guys too, right? If that debt is going to roll over, right, and it's not going to change on a terms basis, it can impair what you do from an execution standpoint, right? So that's typically one of the other things that we really lean in on that, and also understanding like founder loans to the company and vehicles like that.
Interesting. I think your situation is because a fund is buying or is getting equity in a business, like in a software business. They're taking on the whole operation the way it is. Most of our acquisitions are kind of debt-free, cash-free type situations, given when in their stock sales. Okay, Jeremy, you have any questions?
When you were talking about, can you hear me?
Yeah, I can hear you.
Yeah, go ahead.
My kids are really loud, so I had to make some adjustments. When you're talking about debt equity on a table, on a cap table, are there ways that you have seen to like work that off, or is it just negotiations with that guy, or can they price him out kind of as they go around rounds and change the future equity type or something? What's the play there if you've got changing values of how much equity? Like you got 3 founders, but 2 years in, one guy's really doing all the work, the other 2 are basically mid-level employees. Is there ways to kind of work that back to a more equitable place that are normalized or that you see often?
I've seen different sorts of things happen over time, right? So one, obviously, you want to try to negotiate with that person directly and try to find a resolution that way. But sometimes, like, an investor can step in, right? And if a business is burning money, an investor has a lot of leverage into fixing the cap table, and that's typically one of the things that I've seen at the early stage. Also, not just the founder equity piece, but like, let's say that there's some big stack of like safe notes or convertible notes out there, right? And you clean that up, right? The investor that comes in can just basically say like, hey, I'm not going to invest until X, Y, and Z happens, right? And so for that founder who was there for 2 months and left, right, it's you get something or you get zero, right? So there's pressure you can put on folks that way too, like leveraging investors. And then, down like with many companies, like further down the road, typically what I've seen is when there's a hairy situation, there tends to be a pay to play. So one of the companies that I was at on the early stage side, we realized like we had no path to profitability. So we, kind of got our sale process going. And over the course of the sale process, we needed, equity funding to keep coming into business to fund us to closing the M&A transaction, right? And so I remember that the group that did most of the funding there, they basically put a 4x liquidation preference in their convertible note to basically cram down other investors, right? So they'd have most of the economics at the end. So yeah, I mean, a cap table, it can always be changed. It can always be altered. It's a point in time thing.
And as an investor, I don't think I'm going to probably buy a software company, especially not something on revenue or, ARR, as much as it sounds awesome, but I'm able to invest in something. Is there anything
Yeah.
from the investor side, right, that we can kind of take away from kind of this due diligence on either things to look out for or, um, things that are worth noting when it comes to, getting on a cap table and not being diluted with a Forex preference in the future? Um,
Yeah, I mean that one's hard, right? Because the thing is, like, hopefully the company's going up into the right, and
Yeah,
another
because you don't know what's going to happen.
yeah. But Jeremy, I think like one of the things that I would look out for is like on the front end, like, is there debt equity on the cap table, right? And that should be pretty easy to suss out, right? Because oftentimes like founder breakups, it's a common story, right? So kind of what happened with that exited founder, right? And what does their stake look like today? And does that stage present issues, right? With the round as a whole. So that could be one thing that, yeah, you definitely could look out for.
When you say the debt equity, is that those safe notes?
No, it's not the safe notes. It's more like, yeah, again, right, the exited founder, right, who still owns 20%.
Got it.
Yeah.
Okay. Debt equity. Okay, got
How
it.
much? But Jeremy, the other thing too, like Jay, you pointed to this is like with the safe notes, like you want to like understand like what how much capital needed to be raised to hit a certain point, right? And so like one of the companies I've been working with, they've raised like millions and millions in equity, and they're still pre-revenue, right? So very inefficient as a business, and they burned through all that money. So that's a red flag, right? If that's the case. And sometimes they might have the excuse like, yeah, I had to pivot from X to Y to Z, right? But it happens. Like there've been success cases of pivots, but why not fold the old entity and then start a new entity with the clean cap table?
I think even though we may not be buying a software company or anything, I think there is definitely a lot of learning from how technology companies kind of think through it, or how they name things sometimes, or what are the strategies that they use to kind of entangle some of this. Like, because when you think about these situations, it's like the most complex situations, like you got 3 founders, one guy left, some guys, and the company's still pre-revenue or it's not really profitable, and it's got multiple stacks of fundraising and investors, and you trying to entangle all that stuff, and they still figure that out. And I mean, they still have ways to do it, which is pretty impressive. So I always find these, like, even like we talk about the rule of 40. That's kind of like a very simple framework that I can you explain that, the rule of 40?
Yeah, so that's the thing. Rule 40, in my opinion, it's not like really relevant to early stage businesses.
Yeah.
Tends to get applied more like late stage and growth businesses. But
Yeah.
what that is the like a rule of thumb is like for a software company that's growth stage or late stage, if you add revenue growth and EBITDA margin together, you want that to be north of 40%, right? And companies that are north of 40% traded a premium to those that are not, right? And the reason you're adding those up, right, is like, it's okay to be burning capital if your revenue growth is like 100% or 200%. But if you're not, right, and like revenue growth is slow, then you want to be optimizing for profitability at that point, right? So it's a metric that's able to capture companies that, along the journey, right, in terms of where they are.
Yeah. So it's good.
I was going to say too, like I do see like so one company that we're working with currently, it's a software business that's been bootstrapped for 20 years, and so the founder, he is like an amateur expert on tax code. He's actually like read the entire tax code, and he lives in Puerto Rico, and he has that whole thing figured out, right? But the issue is that he set up his financials for tax optimization versus for business purposes, right? So like one of the things that we're helping him with is like he's using these financials that are not even cash financials. It's like these modified cash, right? Set up for tax optimization to get him to an accrual basis, right? So that we can at least have 2 parallel sets of books, because he wants to go raise funding this year. And so he needs to have accrual books, right? So, the issues that you guys see, right, where I think a lot of the owners that you're talking to, right, they optimize for taxes. You do see that from time to time on the software end too. And like the thing is, like, it presents opportunity for you guys, right? Because if it yields a super low EBITDA number, then it's arbitrage for you when you restate this, and you pull out personal expenses and things like that, where you've arbed the valuation.
And
How's
so
that?
go ahead.
So one of the questions, right? So all these QV, and I think there's a bunch of stuff. The safe notes being one, just super interesting to me. When you look at the due diligence required to basically buy into a ongoing, maybe early revenue, pre-revenue type company, I feel like it's a lot more in depth, right? We're talking, debt-free, cash-free purchase here. Is there anything that you think that you guys do in the software world that's really good from a QV perspective that we should try to bring over into kind of buying services and, essential services type B2B stuff?
Yeah, I mean, I alluded to this earlier, which is the contract review, right? Parsing every contract. Yeah. Because so the ARR figure, right? It came from software, but you're seeing it get applied to a lot of businesses that just generally have recurring revenue. I mean, my business, I kind of think about it on an ARR basis, personally. But again, right, the challenging thing is like there isn't like a true gap standard around ARR, right? But there are points of view that thought leaders in the industry have around how ARR should be captured. So understanding contracts, understanding how like ARR is stated, but then having your own view and kind of transforming that to your own view, I think that could be something that would be pretty helpful for you to do.
I like that.
Yeah, it's the tricky thing is that when you're dealing with 30-year-old business owned by 70-year-old person, there's no way to parse out. And you can parse out all you want. You can pay me. That's it.
Yeah.
So so it's a different. I think it's for our own benefit, and also like when you reorganize and restate these things, and you start out clean, you're making the business much more valuable by doing so.
Karthik, have you seen a lot of QSBS optimization, right, for how people are setting stuff up, or is that something that's not really talked about till they're ready to sell?
No, you do see it with startups, like with early stage startups. I think in many situations, like QSBS optimization is something they do, especially if it ends up being a smaller exit.
So what did that look like? How do you think through the QSBS?
I'm not an expert on this, but like I've got like one founder that I'm working with. He bootstrapped his ad tech business. He's trying to sell it right now, and I know there's a lot of work he's done with his tax accountant on QSBS optimization. So there are strategies around that. If it's something that you're thinking to, work with a good tax accountant on that end.
John, any questions? I'd love to go explore if you have done any e-commerce. So how do you think about e-commerce businesses? What to look for? What are some of the things that are common, issues when you're running a QOV?
Yeah, with e-commerce, working capital is a big time issue, right? And then understanding each of like current accounts, current liabilities, that's all important, right? I alluded to the inventory as an example earlier. Again, seasonality, right, tends to be a big issue with e-commerce, right? So you don't want to go buy on a T3, right? You want to definitely use a T12, with a business like that. And then with margins, right, on the COGS, then I think you just want to understand how our raw supply is tracking, right, in terms of pricing. And then is there like price elasticity in terms of what folks can charge, right, to try to squeeze out more gross margin on that end.
So are you actually doing all this during the QOV or doing due diligence? Are you like checking every product and its elasticity, or are you doing all that stuff, or this is just from the buyer perspective? They have to do their own research.
From a buyer perspective. So yeah.
Got it. And in terms of the working capital, how you think through that? Because, the seller may say, oh, you need X to run this business, but then, you do your own research, you're a little bit more conservative, taking in consideration a lot of the seasonality. How do you kind of close the gap between the buyer and seller?
you kind of have to roll with the industry standard, right? Like versus going with whatever the seller's been doing it, right? Because there could be specific things at hand with how the seller is doing it that you might not have access to, right? So I'd err to being conservative. And the question for you guys is, how able are you guys to like lock up a line of credit ahead of closing, right? To give yourself, a bit more room on that front. Right. That, and then also having just extra reserves on hand, right? If you need to feed it in during, lean times.
Sounds good. So you have to actually pay for it. When your multiple goes up a point because you added, working capital to cover,
the e-commerce thing, that's like the pain. That's why I always, stay away from it, because the inventory, because the working capital, because of all these seasonality, and there's such a gap between the information you have and what the seller has. And so it's just no matter how much due diligence you do, unless you're from that industry and you understand that particular product line, you really don't know.
It's like even on the finance end, there's a very specific skill set to D2C and CPG. And, my firm, will sign up for controller work on that end. But I oftentimes just punt on FP&A related work, right? Because you do really need a specialist that's just breathed D2C their whole career.
Yeah. Yeah. And they're stressed out, and cash flows. Yeah. It's nuts.
Ecom feels like a heavy CapEx heavy business to me. It doesn't make sense unless you're already in the space and you're adding on. Like as a single buyer, you're just taking on too much risk.
Although it's interesting with the D2C, because the thing is up until peak COVID, from 2013 to peak COVID, that space raised a ton of venture funding, right? And then when the Caspers and Blue Aprons of the world went bust, funding's dried out for it. So and as folks have had to bootstrap more and more, you're seeing fewer brands get created, right, the past couple of years.
So where are you seeing the opportunity for the aggressive or the curious acquirer? Where are the opportunities right now?
Yeah, that's a very good question. It's interesting, right? Because it's given where interest rates are, and I know that you guys like to, finance with debt, right? I think the way to think about it, right, is it'd be something that would be lower multiple, right? Because I'm trying to draw that analogy to commercial real estate, which Jay, you look at, Jeremy, I know you look at as well, right? Because with commercial real estate, right, when I'm borrowing at 6.5%, I kind of want to be buying assets, right, that are 8, 9, 10, 11, 12% cap rates, or at the very least getting positive leverage, right? But I don't want to be paying 5 cap with 6.5 person interest debt, right? What is cap rate? What over cap rates EBITDA multiple? So I guess that's the opportunity, right? Kind of where can you get that positive leverage with debt today? So I don't know the specific multiples of specific spaces that you look at, like an HVAC versus a pest control business. But I think that's.
We do see some old school e-commerce sites or old school online services that come up once in a while that are in that 3 to 4 times EBITDA multiple. So they do come up once in a while. It's just it's not as common.
Yep, which would basically be a 25% to 33% cap rate if you thought about that.
Yes.
Yeah. And they're ugly as hell. They've not spent any money on R&D or any kind of UX UI.
Mm-hmm.
Yeah.
What about? So I know we touched on it, and maybe it's the conversation's already been answered because you've talked about it a little bit. But when I'm looking at a software company and we're thinking about R&D or improving product over time, is that going on CapEx, or is that a line item for expectation? How do investors think about, hey, I'm buying this great piece of software today, but software gets old, right? I'm getting rid of IMS, right? IMS got bought by RealPage, not a single update in 3 years, and increasing pricing, right? So that's going to be a dead product, I feel like, at some point. How does an investor think about that product continuing to improve, and where do you kind of see them be able to kind of hide the different costs, right, when they're looking at operational / R&D improvements for future work?
Yeah. So two things. One, that's me an on topic. Second thing, that's me a bit off topic. That might be limiting. So on the on topic piece, the R&D costs, like I typically see that in ongoing OpEx, like with software businesses as an example, right? You do see new product development, right? New modules, right? That these folks are working on, and this goes into OpEx, right? Into the salaries of the team there. You might have an argument, right, to again put some of this into the balance sheet, but you should speak to an accountant and do specific testing around that to make sure that you can do that. And then on the second thing, it's not uncommon for folks to buy like legacy software companies, just like milk out whatever remaining gross margin there is left. Like I remember like back in my investment banking days, like this was like 2010 to 2012. I remember like, one of my teammates like participated in like the sell side of Corel. Remember Corel from like the 90s? Like it was like the Microsoft Office alternative. Jay, you might that was still creating revenue, like 10 to 50 years later. I don't know who was using it, but someone was, right? So someone just bought it to basically squeeze out whatever remaining revenue there, or whatever remaining like profit there was, like just getting rid of everyone and just squeezing gross margin, right? Okay. And getting payback and just like letting it run. And like when we were selling an early stage software company, there was a PE firm, right, that offered on it like super low price, but what they would have done, right, was basically milk our platform until it went to zero, and so they make a profit on a DCF basis, just doing that. Because the thing is, like with software, right, it can take forever to like die, right? Because the thing is, like switching off of software, it can take time, especially if there's an implementation that's needed. So even if it's not like there's no new feature development and other things. I mean, IT teams have a ton of priorities, so they might like live with something that's like substandard for a while, right, before they churn. So that could be something you could think about, right? Can you throw some like lowball offers out there to software businesses doing like 1 to 2 million ARR?
Berkshire Hathaway sucking on the end of the cigar for ARR.
That's what it sounds like. Yeah. So are you 100% software and SaaS now, or are you branching out to non-SaaS, non-software companies?
Yeah, no, we're pretty diversified. So, I mean, look, good chunk of what we do is software, but there are a couple of clean tech businesses we're working with. So that's heavy in manufacturing, ag, other elements. So we're doing more of that. Do have a couple of e-commerce customers that we're helping on the controller end, right? One's getting ready for an audit, so my controller is helping them through that, right? With crafting defensible policy memos, whatnot. And then on the QE front, we're really close to taking on an engagement where a guy that I used to work for, he's at a PE company now, and they have a platform company, and they're looking to buy, a 2-location pet grooming company. So talk about helping him with the QE on that front. So yeah, we're diversified.
Yeah, that pet grooming space is going like crazy. Yeah, it's the multiples are nuts. I saw like a 12 time EBITDA multiple on like 3 locations.
What?
Yeah,
let's go buy a salon.
I know. Had like 3 locations. Yeah, it was not even that much. And for some reason, this private equity, you never know these things. But yes, it's really hot right now. Cool. Any final questions, guys?
I got a last one, right? So you think you do a lot of QVs, right? You're jumping in the books. What's the most like egregious thing you've found from like just kind of malfeasance or just kind of some other way that people have just been absolutely cooking the books?
Yeah, so it tends to be cases where like cash doesn't tie out right to what's presented. That's the number one red flag. If that's because things might be misclassified in some places, right? And we can sort that out. But if cash isn't tying to financials, then something is seriously off, and that raises some major red flags.
So where was that?
So that was one software company that we did a QE for, and sponsor saw that, and they ended up walking away.
So they were claiming that there was more income than there actually was.
Yeah, there was. Yeah,
and it was fake invoices, or what was it? Fake clients, or fake implementations, or what was it?
Yeah, basically, like, it wasn't fake invoices necessarily. It was that the revenue was like way overstated. Right. And the thing is, like, the overall free cash flow didn't tie out right to like what we saw in the bank statement. So it was like missing expenses. It was issues with revenue.
It's bad books.
Bad books. Yeah.
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 Cool. Well, all right. Well, thank you, Karthik. Thank you for doing this. We'll share the video with the guys, and hopefully we'll have some guys buying e-commerce companies coming your way.
For sure. And I actually had a deck prepared, so I can send the deck over to you, Jay,
Yeah.
and basically circulate that.
I will.
Yeah.
Yeah, absolutely. Appreciate it. Thank you. Thank you, guys.